Clara Hutchinson, 71, from Gilbert, Arizona, added $4,400 to her checking account at a national bank on June 3, 2026. The funds came from selling her deceased husband's stamp collection to a local buyer. She had kept the collection for 2 full years following his death. Parting with it finally felt like the right decision. She made the deposit, returned home, prepared her evening meal, and gave it no further thought. 19 days afterward, she opened an IRS Notice CP-2000 requesting proof of where the deposit originated and how it connected to the income she had reported for 2025. Clara had submitted every tax return on time for 44 consecutive years. She had never been assessed a penalty. She had never opened an IRS letter that was not a standard acknowledgement. She sat at her kitchen table and went through the notice 3 separate times before picking up the phone to call her daughter. Her daughter reached out to an enrolled agent. The enrolled agent shared something Clara still has trouble accepting. The $4,400 deposit was not the actual concern. The dollar figure was not the problem. What triggered the notice was a specific combination of factors she had no awareness of, factors that the IRS had quietly revised in March 2026 through regulatory direction rather than new legislation, without any press announcement, without any notification mailed to account holders, and without a single visible update on her bank's public-facing website. By the time this video concludes, you will have a full understanding of exactly what changed, why it is disproportionately affecting older adults, what the IRS is already doing with your banking information that the vast majority of people are unaware of, and the precise account arrangement that enrolled agents and tax attorneys are currently recommending to their own family members. I will walk you through that final piece completely, but the background matters first, because without it, the recommendation seems unnecessary. Once you understand the context, it feels completely obvious. Here is what changed in March 2026. The Bank Secrecy Act of 1970 has always obligated financial institutions to submit currency transaction reports for any cash deposit or withdrawal that exceeds $10,000. That limit remains unchanged. It has not been adjusted. Any cash transaction surpassing $10,000 generates a CTR submitted to the Financial Crimes Enforcement Network, commonly referred to as FinCEN. That requirement remains unchanged and is not the focus of this video. What changed is the second tier, the tier that most seniors have never encountered and that appears nowhere in any disclosure document your bank provided when you first opened your account. Under 31 CFR Section 103.18, financial institutions are required to submit suspicious activity reports for any transaction the bank determines falls outside the customer's established account behavior. The SAR threshold is not $10,000. It is not any specific dollar figure at all. The SAR threshold is deviation. Your bank tracks your account activity, builds a reference point for what your standard deposit and withdrawal behavior looks like, and then identifies anything that strays from that reference point beyond an internal percentage that each bank determines independently. You are never informed what that percentage is. You are never notified when a SAR is submitted. Under 31 U.S.C. Section 5318G2, your bank is legally barred from disclosing this to you. In March 2026, the IRS issued revised guidance to financial institutions through FinCEN Advisory FIN-2026-A3. That advisory made no changes to the $10,000 CTR threshold. What it did was broaden the definition of what qualifies as a suspicious behavioral pattern requiring SAR evaluation. Before March 2026, the primary condition for SAR review was a pattern of transactions that appeared deliberately designed to remain below the $10,000 CTR threshold. what the law refers to as structuring. The updated advisory explicitly introduced two additional pattern categories: rapid balance shifts inconsistent with the account's historical behavior, and multiple deposits from non-repeating sources occurring within any 30-day period. That second category is the one creating problems for older adults. If you receive Social Security on the third Wednesday of each month and a pension deposit on the first of the month, your account displays a very clear and highly predictable deposit pattern. Your bank's compliance software recognizes that pattern. It has been developing a baseline from your account's activity over months or even years. The instant a deposit arrives that does not align with that pattern, whether it is money from a garage sale, a repayment from a family member, a tax refund arriving at an unexpected time, an insurance payout, or proceeds from selling something that belonged to you or your spouse, the system flags it, not because the amount is significant, but because the source is unfamiliar to the baseline the system has established. Before March 2026, most major financial institutions set their internal deviation trigger at 50% above a rolling 6-month average. Based on statements from compliance professionals who have spoken publicly in federal proceedings between 2020 and 2025, some institutions lowered that internal threshold to 30% in response to the March 2026 advisory. Others maintain their thresholds have remained the same. The advisory did not prescribe a specific new percentage. It expanded which patterns qualify for review consideration. The inconsistency in how individual banks respond to that expansion is part of what makes this situation difficult to manage. Here is the specific arithmetic behind Clara's situation. Her Social Security deposit is $1,847 per month. Her survivor benefit from her late husband's pension continuation is $980 per month. Her combined regular monthly deposits total $2,827. The $4,400 in stamp collection proceeds represented 155% of her average monthly deposit total, arriving in a single transaction from a source that had never before contributed to her account. That combination, an unrecognized source exceeding her monthly average by more than 50%, placed her squarely within the behavioral pattern that the updated advisory instructs banks to evaluate for SAR filing. A SAR was filed. That did not mean she had broken any rule. It does not indicate she is the subject of a criminal investigation. What it does mean is that a federal report now exists bearing her name, her Social Security number, her account number, and the full details of the transaction. That report is accessible to IRS Criminal Investigation, the Financial Crimes Enforcement Network, and the FBI for 5 years from the date it was submitted, and it directly influenced what happened next. Here is the element that most explanations of this subject leave out, and it is the element that matters most for understanding why summer months carry particular significance. Since 2024, the IRS Criminal Investigation Division has been incorporating SAR data into a parallel scoring model that functions independently of your tax return. The IRS uses an internal rating tool called the Discriminant Information Function, the DIF score, to evaluate how likely any individual tax return is to be selected for audit. A return that scores below the audit selection threshold on its own can be pushed above that threshold by SAR filings tied to that taxpayer's Social Security number. This integration was described in precise detail in Government Accountability Office Report GAO-24-1-06231, pages 47 through 53, released in 2024. The IRS has made no public-facing announcement about this integration at any point. What this means is that your bank account behavior now shapes your audit probability independent of anything contained in your actual tax return. Clara's return contained nothing unusual. Her 2025 income was entirely straightforward. The proceeds from the stamp collection came from personal property, which is generally not considered taxable income unless the item was sold for a profit above its original purchase price. But the SAR her bank submitted created a data reference point that her tax return alone would never have produced. Her enrolled agent spent 9 weeks resolving the matter. The total cost in professional fees came to $1,340. The documentation that ultimately resolved it was a dealer receipt showing the date of the transaction, a description of the items sold, and the sale amount. A receipt Clara almost did not request because she never considered that she might one day need it. Now here is the second dimension of this that goes beyond isolated deposits. And this is where the March 2026 guidance created something meaningfully new. Robert Alderman, 67, from Knoxville, Tennessee, received 3 separate payments during May 2026. His daughter returned $1,200 she had borrowed for a vehicle repair 2 years earlier. He sold a riding mower through an online marketplace for $900, and his homeowner's insurance sent a reimbursement of $1,650 to cover a fence replacement. 3 completely separate transactions, all entirely legitimate, none individually out of the ordinary. Combined across the month, they added up to $3,750 in non-recurring deposits on top of his standard Social Security and pension income. Under the guidance in place before March 2026, 3 irregular deposits from 3 distinct sources would not have triggered SAR review unless the combined total approached the $10,000 CTR threshold. Under the updated advisory, multiple deposits from non-recurring sources within a 30-day window is itself a pattern that warrants a reportable review, independent of the total dollar amount. Robert's bank submitted a SAR. He learned about it 4 months later when he applied to refinance his home equity line of credit, and the lender's internal review process surfaced the filing. His application was delayed by 11 weeks pending additional paperwork. He was never told the SAR was the reason. He received a vague response about verification procedures. An enrolled agent he retained after his own research pointed him toward this explanation, confirmed it. This is not a situation that only affects wealthy retirees or people with complicated finances. Robert's total non-recurring deposits in May 2026 were $3,750. That is the amount that placed a SAR in a federal database under his Social Security number. The misinformation spreading across social media platforms and through email chains right now is actively making things worse for the very people it claims to be helping. The claim circulating is that the IRS established a brand new $600 reporting threshold for checking accounts in 2026. That is not accurate. Here is the precise history. In 2021, the Biden administration proposed, as part of its Build Back Better legislative package, that banks report aggregate annual account cash flows for any account with more than $600 in total activity. That proposal was never signed into law. It was removed from the bill prior to the Senate vote in 2022. It is not current law. No financial institution is required to report your account to the IRS simply because it holds $600. However, and this distinction is the critical one, the defeat of the $600 proposal in Congress did not prevent the IRS from constructing a functionally equivalent monitoring capability through the existing SAR and CTR infrastructure already in place. FinCEN Advisory FIN-2026-A3 achieved through administrative direction what Congress chose not to accomplish through legislation. A tax attorney currently in private practice, who previously spent 17 years as an IRS revenue agent before departing the agency, described it this way in a published interview earlier this year. The $600 threshold is gone, but the SAR expansion delivers roughly 80% of what that threshold would have produced. It required no vote in Congress. It was processed through FinCEN as an administrative update. It is already active. So when someone assures you that the $600 reporting rule was never enacted and therefore you have nothing to be concerned about, they are correct about the rule and wrong about the conclusion. The mechanism shifted, the result did not. Here is what this means for your checking account between now and August in particular. The IRS processes SAR data continuously on a rolling basis, but there is a recognizable pattern in IRS correspondence timing that enrolled agents consistently observe. CP 2000 notices and initial documentation requests that result from SAR-influenced DIF scoring tend to arrive in clusters during July and August each year because they follow the processing timeline of the prior tax year's returns. Clara's June 3rd deposit produced a SAR that contributed to a CP 2000 notice she received on June 22nd, 3 weeks afterward. For older adults whose non-recurring deposit activity took place in earlier months of 2026, those correspondence letters are arriving now. August represents the period when the volume of these notices reaches its highest point according to enrolled agents who regularly handle this type of work. The real question is not whether your account has been flagged. You will have no way of knowing if it has. The question is whether your records are prepared if a letter arrives, and whether your account arrangement going forward prevents the pattern that triggers a filing in the first place. Here is the account structure that enrolled agents are currently recommending to their clients specifically, and that several have set up for their own parents. The arrangement involves 3 tiers and is considerably simpler than it may initially sound. The first tier is a primary checking account that receives only recurring verified income, Social Security payments, pension disbursements, annuity payments, and required minimum distributions that arrive on a predictable fixed schedule. Nothing else is deposited into this account. Not a reimbursement from your daughter, not money from selling household items, not a tax refund arriving outside its usual window, not a monetary gift. This account maintains a flat, consistent deposit pattern that automated compliance systems interpret as a stable behavioral baseline. When the only deposits entering the account are recurring federal and institutional payments, the deviation trigger is never activated, regardless of how large the account balance grows. The second tier is a completely separate account at a different financial institution designated exclusively for non-recurring deposits. This is where coin collection proceeds go. This is where lawnmower sale money goes. This is where birthday gifts go, insurance reimbursements go, and family loan repayments go. Because this account is specifically established for irregular deposits, irregular activity does not represent a deviation from its own baseline. The account's recognized pattern is varied income, which is internally consistent. An account that regularly receives varied and irregular deposits has a different established baseline than one receiving flat recurring deposits. Varied deposits entering a varied deposit account are unremarkable. That same deposit arriving in a flat deposit account registers as an anomaly. The third tier is a savings or money market account that functions as a bridge between the first two. When funds accumulate in the second tier account, you move them into the savings buffer in consistent amounts at regular intervals rather than transferring unpredictable sums directly into your primary checking. The regularity of the movement is what matters most. A $500 transfer from savings to checking on the first of every month resembles nothing like an irregular outside deposit. It looks exactly like a person managing their own finances responsibly across accounts they own, which is precisely what it is. Gerald Brewer, 73, from Baton Rouge, Louisiana, restructured his accounts in February 2026 after his son, a senior compliance analyst at a regional bank, informed Gerald that his checking account had undergone internal review twice during 2025 for irregular deposit patterns. Gerald had not violated any rule. He had sold 2 pieces of equipment from his woodworking workspace, received a water damage insurance payout, and had his daughter repay a loan he had extended for a medical expense. 4 non-recurring deposits spread across 8 months, none individually notable. Together, they created a pattern his son's institution would have flagged for review. Gerald opened a second account at a local credit union. He established it for all non-recurring income going forward. He has not received a single IRS inquiry since. His records confirm no SAR activity following the restructuring. His total financial holdings did not change. His income remained the same. His daily life remained the same. The only thing that changed was the pattern his primary checking account presents to automated monitoring systems. One additional aspect of the March 2026 guidance that has received virtually no coverage relates specifically to joint accounts. Before March 2026, SAR evaluations treated a joint account as a single combined entity with one unified deposit pattern. The updated advisory instructs banks to assess each account holder's individual contribution patterns separately when the account receives deposits from multiple sources. This means that if your spouse sells an item and deposits the proceeds into your shared checking account, but your spouse does not typically make deposits into that account, even a modest deposit can appear irregular when evaluated against your spouse's individual contribution history to that specific account, rather than against the account's combined total deposit history. Patricia Ellison, 74, from Spokane, Washington, received $2,900 from her sister as partial repayment of money she had lent to help cover relocation costs 3 years earlier. She deposited it into the joint account she shares with her husband, the account where his pension and Social Security arrive every month and where she rarely contributes any deposits on her own. The repayment from her sister was assessed against Patricia's individual contribution pattern to that joint account, not against the account's overall deposit history. Patricia's individual contribution pattern to that account was essentially non-existent. The $2,900 appeared anomalous, not because of its size, but because it originated from a third party depositing into an account with a well-established two-source deposit pattern through a contributor who had no prior deposit history with that account. ASAR was filed. Her husband's mortgage refinance inquiry 3 months later triggered a documentation request that added 7 weeks to the process. Patricia discovered the connection only after the enrolled agent they retained traced the sequence of events back through the timeline. Here is your documentation rule going forward. Before every deposit that does not originate from Social Security, a pension provider, or another institution with which you have an established ongoing relationship, write a single sentence on a piece of paper. Record who paid you, what the amount was, what it was payment for, and the date the transaction occurred. Store that paper in a folder labeled with the applicable tax year. If a coin dealer paid you for a collection, ask the dealer for a written receipt showing the date, a description of what was sold, and the dollar amount received. If a family member repays a loan, a brief text message or email confirming the repayment amount and the reason behind it serves as legitimate documentation. If you sell something through an online marketplace, save the listing, the message confirming the agreed sale price, and the payment confirmation. This is not about establishing your innocence. It is about having the answer ready before anyone asks the question. Clara's situation required 9 weeks and $1,340 in professional fees because she did not have a dealer receipt on the day the notice arrived. She had to contact the dealer months later, who fortunately remained in business and was willing to provide a signed written statement confirming the transaction details. That signed statement resolved the inquiry completely. A receipt from the original day of the sale would have accomplished the same outcome at no cost. 3 questions to ask yourself before making any deposit that does not come from a recurring institutional source. First, has a deposit from this type of source ever entered this account before? Second, does this amount fall within the normal range of my typical monthly deposit total? Third, If the IRS were to ask me 18 months from now to document where this deposit originated, could I produce written evidence of it? If the answer to all three is yes, proceed as you normally would. If the answer to any one of them is no, route the deposit to your secondary account and retain documentation in your folder beginning on the day the transaction takes place. Donald Yates, whose story opened this video, spent 3 months resolving a CP 2000 notice, paid $1,100 in accounting fees, and had to obtain a signed affidavit from a neighbor confirming the details surrounding a boat sale. The IRS reviewed the documentation and closed the inquiry with no tax assessment, no fine, no penalty, and no additional amount owed. The resolution was fully successful, but reaching that resolution consumed 3 months of his life and more than $1,000 he had not budgeted for. He told me he keeps a dedicated folder near his desk now. Every time he receives money that is not his Social Security or pension payment, he writes one sentence on a slip of paper and places it in the folder. He said the process takes 30 seconds. He said it costs him nothing. He said it is the single thing he would have done differently from the very beginning. Your bank is not working against you. The IRS is not singling you out personally. What is operating is an automated system that monitors numbers and responds to behavioral patterns without any human evaluation of who you are or what your intentions may be. That system has no awareness that you sold a fishing boat. It has no knowledge that your daughter was repaying a personal loan. It has no understanding that your husband's coin collection was something precious, that selling it was one of the most emotionally difficult choices you made in the years since he passed. The system registers that the numbers move differently than they typically move, and when the numbers move differently, the system does precisely what it was designed to do. Your protection is not concealment. Your protection is structure, documentation, and a second account that costs nothing to open and eliminates the behavioral pattern that sets the entire chain of events in motion.